Okay, so we're now looking at part two of our question, which is us doing the notes to the financial statements. The first one is trade and other receivables. Starting off, we need to calculate our net trade debtors. So that's debtors control less your provision for bad debts. So for debtors control, we started off with a balance of 578,000. Right here, pre-adjustment. And then we had an adjustment to that when we had to write off a debtor. A debtor who owed 9,600 was declared insolvent. So we had to write them off. Some of the amount was paid, but we need to just remove the full 9,600. And that was the only adjustment where we have 9,600. Only adjustment we have that affects our debtors control. So that'll be 578,000 minus 9,600. And that will give us 568,400. And then to get our provision for bad debts, that's just debtors control multiplied by 4%. There it is. So the 568,400 that we just got, multiply that by 4%, and that will give you 22,736. Then we take our debtors control minus the provision for bad debts to get our net trade debtors of 545,664. Next up, we have our accrued income. So for our accrued income, you can also find your accrued income from your statement of income. So as you can see, with accrued income, that means that's income we've earned, but it's not included, so we have to add it. And the only place we added was rent. And let's see the adjustment for rent. We were told the rent for February is still owed by the tenant, so that's why that's accrued income. We had already calculated the amount as 8,400, so we just put 8,400 for our, that's it, accrued income. Next up, we have prepaid expenses. With prepaid expenses now, our prepaid expense, if you remember, we have consumable stores that we had paid for, but they had not been delivered yet. So that would be the 2,250, and that is a prepaid expense because that is not with us yet. We've paid for it, but we don't have it yet. So 2,250, we don't have to calculate the total. The next note is the retained income note. So we'll be focusing here, now, and the other parts. First off, we have the balance at the beginning of the year, and then there's net profit dash taxation. You always put your net profit after tax. And that was given as 1,402,800. Next up, we have the repurchase of shares. That's why I said we had to look at the following information. On the 31st of May 2022, the company issued an additional 1 million ordinary shares at R8.96 each. On the 30th of September 2022, the company declared and paid an interim dividend totaling 928,000. This has been recorded. The company bought back 250,000 ordinary shares at R9.95 each. It was negotiated that these shares would qualify for the final dividend. Okay, and then the final dividend of 8 cents per share was declared. Now we are focusing on the buyback. So with the buyback, what happens is you have that repurchase price, which is R9.95. But in your ordinary share capital note, you can't put the R9.95 when you are recording the repurchase. You need to use what's called the average price. And then, so you have the average price and the ordinary share. And since the average price won't be the same as the repurchase price, you find the difference between the two And then that difference is the amount you use for retained income. Okay, so that means we need to determine the average price since we won't be doing our ordinary share capital note. So how do we determine that? Let's come back here. We have our opening balance for ordinary share capital, which is 37,440,000, and that is 4.8 million shares. What you do is at the top you want the price, the average price. So the top we have the value of the shares, the bottom the number of the shares. So let's do that. That will be 37,440,000 divided by 4,800,000. And then remember in our notes or additional information, we're told the company issued an additional 1 million shares, and that was before the repurchase. So that will be affecting the average price as well. So we need to add that. So that's 1 million shares at 8 rand. What's this? 8 rand 96. So that will give us 8,960,000, and that is million shares. So now we can calculate. There were no other changes to our shares before the repurchase, so now we can calculate our average price. So that will be at the top the 37,440,000 plus 8,960,000 divided by 4.8 plus 1 million, which will give us 5.8 million. And we'll get an average price of 8 rand per share. So now that we know our average price per share, we can determine what amount we'll be using in our retained income. And that's the 9 rand 96 minus 8, give you 1 rand 96. So you'll go to your repurchase, 1,96 multiplied by a million. And that will give you an amount of 1,960,000. And we will be subtracting this amount. The reason why we're subtracting this amount is this is basically what we sold the shares for. The average price, we're using it as what we sold the shares for to our investors, what we issued the shares at, and this is how much we're buying them back for. So we are paying a higher amount than what we had sold it for, so we're experiencing a loss. So that's why we are deducting that from our retained income. Now let's look at ordinary share dividends. Ordinary share dividends, you have your interim and final dividends, or paid and deferred. So you can use either interim and final. So we are told that our interim dividends were 928,000, and the final dividend was at 18 cents per share. So that was 0.18, and we're told that these shares would qualify for the final dividend. So meaning our shares, all shares before the buyback will get the final dividend. So that is the 5.8 million in total. Okay, this is supposed to be a times. Oh, 0.18 times 5.8 million. That will give you 10,404,000. No, sorry, 10,044,000. You add that up with the 928,000 to give you 1,972,000. Okay, that's your retained income note complete. Then we look at the trade and other payables. So we're starting off with our trade creditors. So the adjustments that we had with the trade creditors, let's see. Okay. With our creditors, first off there was that sale. That's 7,000. Wait, No, not the sale. Okay, wait. Creditors, number 8.3. With 8.3, we were told that the following was discovered. An EFT payment to a creditor for 7,200 was recorded. It was to settle an account of 8,000. Remember, it was not processed because we sent it to the wrong account. So that means we still owe our creditor money. So we had to reverse what we had recorded. So we need to increase the amount we owe the creditor again. So that will be 7,200 plus the 800 from the discount received, or just the 8,000. So we'll be adding back the 8,000 to your trade creditors. Okay, then that will be 714 plus 8,000, which will give you 722,000. Then we look at income received in advance. So we have here at number 1 a customer that prepaid the service of 2.8. So that would be part of your income received in advance, and was the only adjustment that had that. 2,800, yes. Then you have your accrued expenses. Accrued expenses, these are expenses that you have not yet paid for. But you, what's this? Expenses you have not paid for but you incurred. The water and electricity of 7,200. Yes, 7,200 water, electricity. And then what else? We had amount of 32,000 was placed. 32,000 advert. Then and off that 32,000, remember we had to deduct the 7.5 for the sale. So minus 7.5. And written off provision. Okay, so those are all your accrued expenses. So you'll have 7,200 plus the 32,000 minus 7,500, and that will give you 31,700. Then we continue. So the other things that have not been included here that we should include, that are payables, our other payables. We already have our trade payables, which is trade creditors. So our other payables are, if you see here, there's that final dividend. Final dividend means it's a dividend that has been declared but has not yet been paid for. They didn't say the final dividend was paid for. So that 1,044,000, that there will be called something shareholders for dividends. And will be part of our payables. $1,044,000. Okay. Then what else was still owed? Okay. Adjustment number 7. The tenant had to give us a deposit. So with the deposit, that 9,000 does not belong to us. That is money that we need to give back to our tenant when their lease ends. So that 9,000, it will be a payable. So we'd have that deposit, a rent income deposit. As part of our payables. Then let's see the adjustments this side. Okay, number 11, we're told a loan repayment of 24,000 is due on the 31st of May 2023. Our next year starts on the 1st of March 2023. That means our loan is not, that portion of the loan is no longer a long-term liability. It's now a short-term liability because it's payable within the next 12 months. So that's why I would have that as part of our trade and other payables. So current portion of loan or short-term loan. That amount is 24,000. And the last part, you were told that an amount of 4,900 was still owing to SARS. So we have a credit balance on the SARS income tax. Of 14,900. Okay, this is supposed to be a 24,000. Okay, don't think there's anything missing. So these would be all your 3 notes completed. Thank you. And if you want more in-depth lessons, you can book me for private lessons or group lessons. I offer those as well.